I sold Apple stock that would later be worth millions. And you know what? I've never regretted it. And that sounds strange because we hear this all the time. If you had invested in Apple, if you had bought Amazon, if you had held Bitcoin. And while that may be true mathematically, it leaves something kind of important out. Hindsight makes investing look simple. Real life makes it complicated. Real financial decisions are not made in hindsight. They're made in the moment with the information that you have, responsibilities that you have, and the life that you're trying to build. When I was younger, my wife and I owned Apple stock, 231 shares. But Apple was not the Apple of today. This was not the company people now look at and say, well, of course you should have held it. At the time, we had a family to provide for, and we needed a house. And when Apple moved up, I sold the stock and used the money as part of a down payment on our house. Now, if you look backward, you could say that was a mistake. Those shares would be worth millions today. But I've never looked at it that way because that money did something real for my family at the time. It helped us build a house we raised our kids in and still live in today. It moved our life forward. And this is where young investors get trapped. They look at what an investment became later and they judge the decision as they knew the ending when they made it. But you don't get to invest with future information. You invest with today's facts, today's risks, today's cash flow, today's responsibilities. And if you don't understand that, hindsight can make you regret decisions that were actually reasonable. It can also push you into worse decisions later. Because once you start thinking, I missed Apple, or I missed Bitcoin, or I missed Nvidia, you start looking for the next one. And that's where the problem begins. You stop building a plan and you start chasing a story. And that's one of the biggest investing mistakes that I see young adults make. They're not just buying investments. They're buying the feeling that they might be early. They hear someone talk about a company online. They hear a friend talk about a stock at work. They see a chart going up and they hear, this is the future. And suddenly the question is no longer, does this fit my plan? The question becomes, what if they're right and I miss it? I understand that because I made the same mistake when I was younger. I started out investing in solid blue chip companies. And then I met someone who sounded a lot smarter than me. He said, Brian, invest in these companies. CMGI, Global Crossing, they're the future. And so I started shifting some of my investments. Today, those companies are gone, bankrupt. And I learned something important. Confidence is not competence. Just because someone sounds smarter than you are doesn't mean that they are. But here's the deeper lesson. I was vulnerable to that advice because I didn't have enough structure around my decisions. Now, I had investments, but I didn't have a strong enough framework, and that's what young investors often miss. The mistake isn't always buying the wrong stock. The mistake is buying, holding, selling, or taking advice without rules. Because without rules, every confident voice sounds like a possible answer. Without rules, a rising stock feels safe. A falling stock feels broken. A popular stock feels obvious. And a missed gain feels like failure. That isn't investing, that's reacting. And as I got older, I became a different investor. I started setting limits on how much I would put into any one investment. I stopped putting too much of my money into one idea. If I bought something, I wanted to know why I owned it. What does the company do? How does it make money? Are sales increasing? Are earnings growing? Is debt becoming a problem? What could threaten the business? Is the company reinvesting back into itself? Because trendy today does not mean durable tomorrow. A lot of people buy the story, but they don't understand the business. They know the product, they know the hype, they know the name, but they can't explain how the company makes money or what could damage it. And if you can't explain why you own something, you're going to be much easier to influence when the price moves. That becomes a real problem when the stock drops, because a stock being down does not automatically make it cheap. And a stock being unpopular does not automatically mean that it's broken. There's a difference between a stock that's broken and a temporarily unpopular stock. That difference is huge. I'll see stocks that will drop in price, but when I go look, I may see why. Sales are dropping, earnings are dropping, debt is rising, the outlook is weakening. And those are red flags in the business, and I don't want that. Someone else may look at the lower price and say, hey, this is a buying opportunity. Maybe, but only if they understand why the business is down. Was it a one-time issue? Was it temporary? Was it, or, maybe the company is starting to crack. And that's the question. Before you buy the dip, ask what caused the dip? Did the company change? Or did Wall Street's opinion change? And that matters. I recently bought more stock in a company where I already had a small position. The earnings came out and the earnings were fine. The company's outlook was fine. The business was still chugging along, but the sector was in and out of favor with Wall Street. The stock price was taking a beating, but the street was saying, don't buy. Now, the younger me would not have touched that stock, not because the company was bad, but because the price action would have scared me away. Now, the older me, I looked at it differently. I had done my homework. I understood why I owned it. I understood what the company did. And I looked at the earnings. I looked at the outlook. I looked at whether the business itself had changed. And I felt I was able to buy it at a discount. Now, it doesn't mean that I'm going to be right. That doesn't mean that every beaten down stock is a bargain. But it does show the difference between reacting to price and evaluating that business. A falling stock should trigger research, not emotion. That's the difference between being influenced and being informed. The same applies when a stock goes up. Early on, if a stock ran up, man, I might be willing to sell all of it. And as I got older, I learned it didn't always have to be that way. Sometimes I'd take some profits off the table. Sometimes I'd recover part or all of my original investment. And that made it easier to let the remaining shares ride because I had already reduced some of my risk. And then I could deploy that money into another researched investment. And that helped me to diversify. The point is not that everyone should sell every time something goes up. The point is I stopped making every decision from emotion. I started using rules. Rules for buying, rules for selling, rules for taking profit, rules for how much money I should put into one company, and rules for what would make me walk away. That's what a lot of young investors are missing. They own investments, but they don't have a decision-making process. I had a client who got into crypto early. His original investment was less than $10,000. And at one point, he was up over $500,000. He held a lot of Dogecoin. To say he was happy, okay, that was an understatement. And I asked him, okay, what's your exit plan? And he looked at me, and I could tell you, he had never thought about it. And he was close to retirement. And I was like, dude, you're up over $500,000 in a meme coin that is extremely volatile. You're getting ready to retire and be on fixed income. That's the part people don't think about. Being up big can create a problem too. Because if you don't have a plan, you may not know what to do with the gain. You just keep holding because that number feels exciting. But excitement is not a plan. And never sell is not a plan by itself. Sometimes holding is right. Sometimes taking profit is right. Sometimes selling is right. Sometimes doing nothing is right. But the decision needs to come from a framework, not fear, greed, regret, or someone else's opinion. Now, this is also where index funds come in. For many young investors, a broad, low-cost index fund can be a better foundation than trying to build a portfolio from individual stock ideas. But even there, you have to know what you own. Don't assume that just because someone says index fund or ETF, it automatically belongs at the foundation of your financial life. Before you buy it, ask what index it follows, what companies are inside it, and whether it's broad or concentrated in any one sector. Ask whether it's built for long-term investing or whether it's built around a trend. And that label does not protect you. Understanding what you own does. That matters because markets will correct. They always have. I've lived through the dot-com crash, the financial crisis, COVID, the sharp drop during the tariff period in 2025. Each time the headlines were bad. Each time people were asking if this was different. And each time investors had to decide whether they were going to follow through their plan or follow through with their fear. If you don't understand market drops before they happen, you'll treat normal market behavior like a personal emergency. And that's when people sell, at the wrong time. Or they stop investing completely. And that may be the biggest long-term cost. Not just the money they lost, but the years they stop investing after. Because compounding doesn't help much if you quit the process. A lot of young adults, they think compounding is about finding that one perfect stock and holding it forever. For most people, it's more basic than that. It's starting, adding consistently, staying invested, avoiding emotional decisions, not putting everything into one idea, not getting scared out of the market every time prices fall, and not letting one bad experience convince you that investing is just gambling. And that's why the Apple story matters. The lesson isn't that I should have held Apple forever. The lesson is that every investment decision has to be judged by the plan, the purpose, and the information you had at the time. Selling Apple helped my family buy a house, and that mattered. Chasing CMGI and Global Crossing taught me what happens when you let someone else's confidence override your own framework. And that mattered too. Buying more of a company when Wall Street doesn't like the sector only makes sense if I understand the business and I know the risk I'm taking. Taking profit can make sense when it's part of a plan. Holding can make sense when it's part of a plan. Walking away can make sense when the business is broken. The danger is not buying or selling. The danger is doing either one without knowing why. The danger is not missing the next greatest investment. There will always be another great investment. The danger is building your financial life around trying to find it. Before you chase the next stock, ask better questions. What do I own? Why do I own it? How does it make money? What could hurt it? How much of my money belongs in it? What would make me buy more? Take profit or sell? And if the stock drops, ask one more question. Is this company broken or is it just temporarily unpopular? That one question can keep you from confusing a warning sign with an opportunity. And it can also keep you from walking away from a solid investment just because the market's in a bad mood. This is what I want young investors to understand. The goal isn't to look back 20 years from now and torture yourself over every stock you didn't hold. The goal is to make decisions that fit your life, your cash flow, your time frame, and your plan. Because investing without rules turns every price into pressure and every confident voice into temptation. But when you know what you own, why you own it, and what role it plays in your financial life, you're much harder to push around. That's what this channel is about. Not hype, not chasing the next big thing. Practical financial thinking so you can build a foundation, protect your cash flow, and make decisions with more clarity before the market tests you. We'll see you in the next video.